Please see the full disclaimer on your screen before we begin.
Welcome to this explainer. I am absolutely thrilled you're here today. We're going to completely demystify commercial real estate investing. We're taking that complex, intimidating language of institutional operators and breaking it down into a super clear, structured blueprint. If you've ever felt totally overwhelmed by the numbers in a real estate deal, or maybe you just want to sharpen up your analytical edge, well, you are in the perfect place. We're going to build your toolkit step by step, and it's entirely focused on making these concepts accessible and, most importantly, practically useful.
Let me start by asking you a pretty straightforward question. Do you speak the native language of commercial real estate? Seriously, think about it. When you're looking at a property, do you actually sound like a seasoned principal? Or do you kind of sound like a passive observer to the brokers and lenders you're talking to?
Now, the really crucial point here is that this isn't just about sounding smart, right? It's literally about financial survival. Because without mastering this specific vocabulary, you risk drastically misinterpreting an offering memorandum. You risk completely miscalculating your returns. And perhaps most dangerously of all, you risk losing all of your credibility in your very first negotiation. Understanding these core metrics is the only true way to accurately measure risk and reward.
So to get you fluent, here's our roadmap for today's explainer. First, speaking the CRE language. Second, measuring income and risk. Third, leverage and cash flow. Fourth, tracking long-term wealth. Fifth, the $10 million blueprint. And finally, the balancing act of deal analysis.
Section 1. Speaking the CRE language. Moving beyond good deals to professional analysis.
All right, let's dive right into this. It is time to move way beyond just hunting for quote-unquote good deals and step into actual professional analysis. The truth is, institutional operators and lenders, they never use phrases like cheap buildings. They just don't. Instead, they are laser-focused on three things: risk-adjusted yield, capital efficiency, and operational velocity. Mastering these concepts is exactly what separates the amateurs from the true professionals who are making highly calculated, strategic moves out there. So let's start breaking down the actual pillars that build these concepts.
Section 2. Measuring income and risk. The foundation of deal analysis. This section focuses purely on what the property actually generates and how the market perceives it. So our very first pillar is net operating income, or NOI. Think of this as the pure operational profitability of a property before any financing costs or income taxes are even considered. Basically, you take your gross operating income and you subtract your operating expenses. We're talking things like property taxes, insurance, utilities, and management fees. NOI is absolutely vital because it tells us exactly how efficiently a property runs as a standalone business. It explicitly excludes your mortgage or any heavy capital expenditures, and that allows you to compare two properties apples to apples, entirely independent of how they happen to be financed.
Once we have the NOI, we can figure out our second pillar, which is the capitalization rate, or usually we just call it the cap rate. This is the rate of return a property would generate if you bought it entirely with cash. The formula is simply your NOI divided by the purchase price. Cap rate really is the ultimate measure of risk and market sentiment. It shows the direct relationship between the income a building produces and the price tag the market places on it.
Now let's look at how that risk-to-yield trade-off actually works out in practice. On the left, we've got a 4.5% cap rate. This might be a building leased to a premium corporate tenant on a long-term triple net lease. It's highly predictable, making it super low risk, so investors are willing to accept a lower yield. On the right, though, we have an 8.5% cap rate for an unbranded boutique hotel. Hotel income fluctuates daily, right? That means way higher operational volatility and higher risk. Therefore, the market demands a much higher yield to take on that specific asset. It's a fundamental rule. Safer assets yield less, while riskier assets demand higher returns.
Section 3. Leverage and cash flow. Financing your investment.
This is where we shift our focus over to how loans and your out-of-pocket cash actually interact. Pillar number 3 is loan to value, or LTV. This is simply the ratio of your commercial mortgage balance relative to the total purchase price of the property. LTV is exactly how lenders manage their vulnerability and assess risk. Typically, commercial lenders are going to be looking for an LTV somewhere in the range of 60% to 75%. In practice, a 70% LTV split means the lender is taking 70% of the risk by providing the loan, while the investor puts in 30% equity, which is their skin in the game. Higher leverage, meaning a larger loan slice, well, that can massively amplify your returns. But it also increases your vulnerability to market downturns because you have a much smaller equity buffer if the property value drops.
Once that leverage is applied, we can calculate our fourth pillar, which is cash-on-cash return. This is the annual pre-tax cash profit you pocket relative to the actual liquid cash equity you invested. While cap rate assumes an all-cash purchase, cash-on-cash actually factors in your mortgage payment. It takes your NOI, subtracts your debt service, and divides that remaining cash flow by your initial equity. This tells you exactly how hard your physical cash is working for you year to year.
Section 4. Tracking long-term wealth. The horizon.
Now we're going to look past single-year snapshots and focus on the entire horizon of the investment. Our fifth pillar is the internal rate of return, or IRR. This is the annualized percentage rate of return earned on each dollar invested for the exact duration of the holding period. Essentially, it accounts for the time value of money. IRR is a measure of velocity. Unlike cash-on-cash, which looks at just one single year, IRR captures the efficiency of your capital over the entire life of the investment. It factors in annual cash flow, sudden expense spikes, and of course, that massive final payout when you eventually sell the property. To balance IRR, we have our sixth and final pillar, which is the equity multiple. This measures the total absolute cash return to you over the lifetime of an investment relative to your initial cash deposit. If IRR is all about the speed and velocity of your money, equity multiple is about the pure volume, how much absolute total cash actually ends up back in your hand. So if a deal yields a 2.0x equity multiple, it simply means you doubled your money over the course of the project.
Section 5. The $10 million Blueprint. Putting the toolkit into practice.
All right, it's time to synthesize all these isolated gears into one interlocking real-world scenario. I want you to imagine we are underwriting a value-add multifamily property right now. Let's say the purchase price is exactly $10 million. We're going to run this property right through our new toolkit.
Here's exactly how the mechanics of our deal unfold. First, income. After paying taxes, insurance, and utilities, our building generates $650,000 in net operating income. Second, yield. Because we're buying a $650,000 income stream for $10 million, our market yield is a 6.5% cap rate. Third, leverage. We secure a 70% LTV commercial loan, meaning the bank gives us $7 million and we put in $3 million of our own cash equity. Fourth, cash flow. Our new mortgage costs $440,000 a year. We subtract that right from our $650,000 NOI, leaving us with $210,000 in net annual cash flow. Fifth, annual yield. Pocketing $210,000 a year on our $3 million out-of-pocket equity gives us a really solid 7.0% cash-on-cash return. And finally, the exit. After 5 years of optimizing operations, we sell. The combination of our annual cash flow plus the sales profit turns our initial $3 million into $6 million total. That means we achieved a 2.0x equity multiple and a 15% IRR. As you can see, everything is connected.
Section 6, the balancing act. The golden rule of deal analysis.
This dictates exactly how you must wield this newly acquired language responsibly. In commercial real estate, there is this constant tension between short-term needs, represented by your cash-on-cash return, and long-term goals, represented by your IRR and equity multiple. We call navigating this the PRI Paradigm. The fundamental rule of the PRI Paradigm is this: never fall in love with just a single metric.
Why? Well, because isolated metrics can totally lie to you. You really need to be aware of the dazzling 22% IRR that looks amazing on a spreadsheet, but is entirely built on a highly speculative projected sale price way out in year 5. If that same deal offers a dangerous 0% cash-on-cash return in years 1 and 2, your investment might literally starve to death before it ever even reaches that finish line. Prioritizing long-term velocity at the total expense of immediate annual cash flow can be a fatal flaw. You absolutely have to balance both sides of the equation to survive and thrive. So, you now possess the foundational toolkit of a commercial real estate principal. You know exactly how to measure pure profitability, assess market risk, utilize leverage, and track the true velocity and volume of your wealth. So I'm going to leave you with this to reflect on. As you look at the properties around your city tomorrow, which metric will drive your next deal? Will you prioritize immediate cash flow or long-term growth? The choice and the math is now entirely in your hands. Thanks so much for learning with me today.